Okay, everybody, thank you for joining us. We're going to get underway here, and some people are going to be still joining us as we start. For those of you who aren't familiar with us, a company name is Investors Advantage. We're located in Westlake Village, established in 1979, and been in Westlake Village for over the last 30 years. We primarily do money management and financial planning, and we're big advocates of risk management. So through this whole last decline that we've seen the last month, our clients have held up very well, and we're very happy to share what we've been doing and what you could be doing. I'll bring on John Grace now. He's the president and founder, and he's going to take it from here.
Thank you, Daniel. And folks, Daniel didn't introduce himself, so I will. If you don't know Daniel, you will when we meet. He is my favorite math man. That's what I like to call him, because he's really good at it. And, you know, when you're not really super at math, you like to have people around you who are really super at math. And Daniel's been here for, gee whiz, it's now over 13 years. I think it was right out of Kalu. So good combination. I try to get the words right. He does everything he can to get the math right. Jasmine does everything she can to make sure that all the pieces come together. And by the way, you'll kind of find it interesting that Jasmine Alvarado, went to Midland University, I believe, on a wrestling scholarship. And I just like to say that when Jasmine's on it, she's on it like two coats of paint. So let's talk about what's going on here. We're calling this Conquer the Crash. And I want to start by saying something to you that I think is very important, because one of the things that the securities industry has been very good at, and I think to a fault, again, I've only been doing this since 1979, so to a fault, I submit to you that the securities industry has conveyed one message very well. Buy and hold and hope, sit and take it. I'm trying to say to you, I'm insulted, all right? Because 40 years ago, that's all we had. Today, we have a lot more tools and a lot more capability. And frankly, many of us are very, very lazy. My peers are 41 years, so, you know, I can call us out because we keep saying the same old, same old. We say, well, I've been in the business for 20 years. Well, maybe. But the truth is, you've probably been in the business 1 year and repeated it 20 times. You didn't show your clients anything after 2000, anything after 2008, did not prepare them for fourth quarter 2019. And so now, so many of our peers right here on this corner of Westlake and Thousand Oaks Boulevard, they're all around here. I mean, this is like Command Central. And we look like deer in the headlights. We're flat-footed. We don't know what to do. We don't know what to say. That's not us. We've been preparing for this round since 1999 after we started paying for independent research. This isn't our first time to the rodeo, and each time the crisis happened, we learned something and went to work to see how we might apply it. So let's talk about, you know, you don't have to sit and take it. You can win by losing less. And after a volatile session yesterday, stocks rose today as investors continue to monitor coronavirus developments amid early reports that the government is considering exit plans to restart businesses closed due to the outbreak. Now, the Dow was up over 700 points, or about 3.2% today. Not a bad day. I was just chatting with someone who said, I just put $250,000 in a bank account where I'm getting 2%. Well, then you missed 3.2 today. And let's understand 2% after inflation and taxes is a guaranteed loss. You won't make that up with volume. While the S&P 500 climbed 3.2% today, and the NASDAQ advanced about 2.5%, just all in one day. Now, the S&P 500 jumped more than 20% above its recent closing low on March 20th. This year, of course, that's through Yahoo Finance. And the session highs, interestingly enough, seemed to occur after Bernie Sanders made his announcement to abandon his bid for the candidacy of president. So VP Joe Biden, of course, that's vice president, is seen by Wall Street as a more market-friendly candidate and closer to the Democratic nomination. So our trademark is the proof is in the planning. And we've got a couple of quotes here, one on the screen and one that I will give you. This one, of course, comes from Benjamin Franklin. By failing to prepare, you are preparing to fail. I think he sums that up. And the other one I like that I can share with you is from General George Patton. I really love this one. If everybody is thinking alike, then somebody isn't thinking. I think he nailed it. Let me repeat it. If everybody is thinking alike, then somebody isn't thinking. So when we move on and we see that the S&P is off year to date about 15%, 14.88 per CNN Business as of today. And you can see here from the high back on the 19th of February to the low so far this year, at this point, March 24th, how quickly the market lost 24%. You can see that in the circle on the right, the red. And you can see exactly what happened on the days and how the response was. It was near immediate. Well, why was it so fast? Because we've never had a situation where everything just came to a stop. Not a slowdown, a stop. And by the way, speaking of stoppage, we'll come back to this, and hopefully please submit your questions as we go along here, and Daniel will read them when we're done. But I mean, it took about 3 years for the US to get through the bottom of the unemployment at 24% with the Great Depression. At the rate we're going right now, we could very well reach those levels, and I mean even higher, 25 to 30% by the way I look at it, in less than 3 months. So things are moving quickly. I mean, you can just feel it. You know, it feels like February, January, it was magnificent, right? And all of a sudden, everything's turned upside down and people are completely dizzy. I mean, it's just fascinating. So now let's look to see how the impact has affected various industries. Led by transportation, we can see that the revenue declines are, I mean, they're just horrific. Imagine being in any of these businesses. You might be in a business, talking to my friendly, my cleaners, right? Husband and wife team. They moved here from Korea. He was an engineer, then he was a banker. And he says, John, my business is down like, he's good with numbers, 74%. I mean, hopefully that doesn't last long, but it really looks like a ghost town in many businesses these days. And yet, when we look at the bottom here, the good news is we're enjoying the libations, maybe not at a bar or someplace out, but we're bringing it home and we're drinking it up. So that's there's always somebody, there's always a winner and a loser, 100% of the time. And so we want to lighten up on the losers, but look for the winners, and there's always a winner someplace else. So let's look back to kind of get a perception as to how long this might last. And we went back to see the 1918 Spanish influenza pandemic. We knew it as the Spanish flu. It seemed like it affected about 500 million people around the world, which at that time was about 20% of the population, of between 1.8 and 1.9 billion. That comes from the cdc.gov, and that's a good source, by the way. The first of the two pandemics involving H1N1 influenza virus, that was the first one, with the second being the swine flu in 2009. And the interesting thing about 2009 is some countries, not the US of A, learned from past crises, like Taiwan, and many of us did not. So we didn't learn from the past. We seem to be repeating the past. And part of the reason I mention that to you is because I see the same parallel when it comes to how people invest. In fact, I happened to bump into almost literally 3 of my neighbors, all retired, and I've never seen 3 grown men. They must be in, I don't know, early to mid 70s. I thought each one of them I spoke to was going to cry because I've never seen them like that, but they won't give me the details, but they're looking at their accounts. And, I think as of March 24th, again, we were off 24%. Apparently they were off much worse than that. Our clients held up much better than that. So I'm really sorry that people seem that they have to sit and take it. The truth is they don't, but we have to ask for help, just like we used to ask for directions to figure out where we're going to go before we had, the cars would do all the work for us, or the phones would do all the work for us. But what I really want you to know here is, 25 days until the peak. You can see about 2 months until the first day of no new cases. So it looks like in the cases that we can study, it's a bad 2 months. And I don't know that there's any way to accelerate that, and the funny thing about, let me say it this way, we in the United States in particular think that we can just mechanize everything, right? That the economy can work because the Federal Reserve is so omnipotent and so powerful that they just have the capability to put a thermostat on the wall and the machines will cool and warm the room to keep everybody comfortable. Well, I've got news for you. It just doesn't work like that. Maybe for a minute, but not for long. At the end of the day, if you want to get a sense for how the economy is working, if I told you I'm going to make the economy grow by 16%, I sure hope you'd have doubt. And by the way, I hope you have doubt at 4%. Here's one of the things that you're not hearing, and that is on a global basis, this is mind-blowing. That we have more people in the world, 65 and older, than 5 and younger on a global basis. We have never been here before. So for anyone to declare that I've got the magic wand and, you know, the soft touch for just making the economy do as I want it to do, I'm sorry. You know, as we get into our 60s, we're just not looking for our PF flyers that we had back in the 60s and the 70s, so we can lace them up and jump higher and fly farther, right? It's just not going to happen. So we need to look at things in a more realistic fashion, as far as I'm concerned, and that way we're better prepared for the, you know, the unknown. Now, let's look at our next one here. And tomorrow you want to look at the job numbers. I don't expect them to be pretty. And these numbers that you see here, like the most scenario, economic shutdown, 2 months, gross domestic product per quarter, second quarter, 15%. These numbers are, isn't this amazing? Old by maybe 5 or 6 days. The numbers we're seeing suggest that this could be more like 30% for the second quarter. You know, that's pretty serious. And if it is the case that we have 2 negative quarters, remember, no one can forecast a recession. You only know it after the fact. But when you have 2 quarters that are negative, that is indicative of being in a bear market. And it also may be indicative of increasing the chances of a recession. I said back in December that I thought the odds of a recession in the US of A was about 30%. In January, I said I think the odds were about 80%, about 85%. Today, I submit to you that the odds are 100%. We're not going to get out of this without going through a recession, or maybe even worse. But also, let me say this. Don't get fearful of that. Embrace it. In other words, what can we learn? What can we apply? How can we be better prepared? There's always going to be a turnaround. There's always going to be upside. And to that point, if we look at Great Depression 1, which is one of the things that I find fascinating, we have studied it just up one side, down the other. On a per capita basis, more Americans became millionaires during the Great Depression than any other time in history. That should be heartening. No matter how bad it got, there was a terrific upside for those who were prepared. And I just wrote an article yesterday that will appear in several newspapers. I said, you know, in fact, my title was "Act as if a recession is in the cards." And what I'm trying to say is pay down all the debt you can, pay it off. Do not take anything more. And part of the problem, and this has been a growing problem for the last 10 years, so this didn't just show up in the last 3 months, the level of debt, whether we're talking about consumers or businesses or countries, is higher than I've ever seen in history. In fact, higher than we did see in all 3 cases, consumer, business, government, than we saw in 2008. So here we go. We have not learned much from 2008, and we certainly haven't applied much. And most of us are living on the credit card like we could be the Kardashians and just put it on the charge card and look great, and then you miss a payment and it doesn't look so good, or certainly not feeling so good. All right, so we don't suggest that you have to be able to forecast the future. In fact, I'm going to say it is futile. And we're going to suggest that you don't need to see the future to prepare for it. Now, while our peers often look like deer in the headlights, we've been preparing for something like this since 1999. And that's because we began spending like $10,000 a year for independent research and independent thinking. And we're constantly looking at things like engineers who remind me they put a man on the moon. What have you done? So we love working with the rocket scientists, for example, who are trained to look at things from the perspective. They don't look at it, are we being optimistic or pessimistic? They look at it from the perspective of how bad can it get? Show me how bad it can get, and then help me see whether or not I can live with that, or how to set it up so that it won't get that bad for me. So, you know, that's how we look at it. Let's figure out with you how you can be more diversified than you've ever been. The static models of 60% stocks, 40% bonds, I'm saying to you it doesn't work. When we look at the endowments and foundations, not to say that this is a template to follow, but with Yale, for example, with about $29.4 billion, we count 7 to 8 different asset classes. Think of it this way. Whatever you're trying to hold up, it may hold up okay with 2 or 3 legs under your stool, But when you have 7 or 8 legs under your portfolio, that's a stronger portfolio. And what it means is we don't take big bets. We diversify unlike we've ever done in the past. And that means that greater diversification may mitigate some of the losses in one area while you're seeing gains in another area. But if we put our life savings on, 60% stocks, 40% bonds, or vice versa, that's 2 asset classes. That's not a very stable stool for your, life savings. So do real planning. Please do not do what so many people have done, which is throw darts in the dark. And if whatever you put that dart on, it went up, you thought you were smart, and frankly, it had nothing to do with intelligence, it just went up. And if it went down, that didn't have anything to do with intelligence either, it just went down. So it's not about intelligence. You don't see the future. I don't see the future. It's about, how can we get the kind of gains that we need, but what are those gains? And what kind of account do we need behind door number 1 so that after your last paycheck, you can see the odds are that I have the kind of money behind door number 1 that will provide me with an income that is the equivalent of the income you used to work for. If it's $60,000, is it $80,000? I don't care, but you want to have the equivalent income that keeps you in chips. It keeps you having options, as opposed to, oh my goodness, I didn't save a dime and all I can do is get by on Social Security. That's not my idea of fun, and unfortunately, that's where so many of us are headed. And then number 3, active management. The best way I can say that to you, it's not a new word. The active management strategies we were first introduced to, again, 1999, 2000. And in fact, our office was part of a beta test for a firm out of the UK where they were starting a new home office. And they were saying, we're going to look at what we can do to actively manage accounts. We looked at it in 2000 in Denver, found them to be promising, but a little expensive. And guess what? In 2000 to 2002, the NASDAQ was off about 80%, as I recall. Dow and S&P was off about 50%. By the way, most of that took place in about 30 months. And the actively managed accounts actually held up better. A little more expensive, but were slightly positive in 01 and quite solidly positive in 02, as I recall. So we saw the same thing in 08 and 09, again in fourth quarter 2019. So the simple way I can explain it is, remember the movie Karate Kid, where it was wax on, wax off? So just to make it as brutally simple, you think of it as you had $1 million in January of 2008, and by 12/31, the market was off about 37% per Yahoo Finance, okay? But if your account went from, let's say, 5% cash of the 1 million to 60% cash, which of course would be $600,000 by year end, you held up better. Now, we don't need a swing for the fences. We don't need to swing for the fences. We don't need a Hail Mary pass. We don't need a hope and a prayer. If you're off 20%, the math is you need 25% to get back to it. If you're off 50 for whatever reason, you need 100%. And if the account's off 60%, I think the math is we need like 150% just to get back to even. That's kind of daunting. I don't like those odds, but if we can keep the losses below 20, so then we may, that may happen. 5% a year with no withdrawals, we're at 25, we're back to even. So active managed wax off out of aggressive assets, be they bonds or stocks or anything that's liquid, that's in an aggressive position at the beginning of 08 and into cash by the end of 08. So that's wax off. In 09, starting March 9th, for example, that's when we saw all these magnificent gains starting around March 9th, 2009. That's when we want to be back in risk assets. And so in some cases, the portfolio in 08 was 60% stocks, 40% bonds. And by the end of 08, it was the reverse, 60% bonds, 40% stocks. And then in 2009, the portfolio rose to about 70% stocks. And that was a very good year, 2009. That combination, being off no more than 20%, getting the gains of 25% or better in 2009, means that the investors were whole, in our experience, in about 2 years. In traditional, more passive investments, It took over 4 years to get back to even. And that was during a very strong market. So we want to limit the losses to stay in the game. And that way we don't need that Hail Mary pass. And you don't have to feel like these poor guys I saw over the weekend, they look pitiful, frankly. I mean, they don't like want to throw in the towel. I'm like, no, we can do better work. So over the past month, what we've been doing is proactively calling our clients to review their accounts. We're not deer in the headlights. We're happy with the results. We love this work. We want to do more of it. And we want, in the light of the real world, sometimes people say, in fact, we just had a call before we got to go here to do this with you, where the couple may be on here. When I was on the phone with the husband, he says, I can accept a 50% loss. We gave them some tools to use, which Jasmine will be providing you after this call, which help them sit down and look at together. No. We, me and the wife and me, we're willing to accept a 5% loss. Now we've got something to work with, because if you recognize your loss parameters, what we want to do next is see, is it possible to build a portfolio that might perform within your specific loss parameters? That way, you don't have to look at the news. You don't really have to care about the news. If you're within 5, let's say to 20% of your number, whatever that number is, you know you can rest at ease. If it gets ugly in the real world and you go, well, I said I could live with a 50% loss, John, Daniel, Jasmine, but I lied. Okay, we'll go back and we'll readdress it so that the account becomes more conservative, because sometimes people say things, until they get in the heat of the moment or the reality, and they're like, okay, I'm wrong. That I don't know what I was thinking, but this is just way too much for me. So what can you do about it? And in my experience over the last 40 years, I find that savvy investors hate losses more than they love gains. So speaking of that, here's a good example for you to look at. And let me ask a question, and maybe some of you can submit a question, the answer to Daniel. This is Mexico Beach, Florida, 2018. I think it was Hurricane Michael had just come through town. And I want to ask you, what do you think caused this house to be left standing? Do you have any thoughts? Please submit them in the chat box. Do you have any, Daniel?
Yeah, one person said divine intervention.
Divine intervention. I'm laughing because I did a presentation, and I started with this slide before my peers, about 100 people in the room. And that was one of the answers from my peers. And then I said, well, is there another answer? And the next answer I got was act of God. And I'm looking at this group going, wow, you guys are kind of out of touch. Okay, does anyone else have a theory? And someone said, yep, I saw that story. The house was built to last. I'd go, correct. You go to the head of the class. That's exactly right. So what I was saying to my peers is, folks, ladies and gentlemen, do we build portfolios where the hurricane comes and robs everyone of what they used to have? Or do we build it to last? Now, let's dig further a little bit, because it gets interesting to me by analogy, but it does apply. Apparently, this was a physician and his nephew. I forget what the order is, but they built this house in 2017. And they found remember, when we build houses, what do we typically do? Minimum standards? Kind of looks like that desolate area behind here, right? Minimum standards. That's how most of our houses are built. They said, no. Minimum will not work for us. Now, have you built anything that could withstand a 250-mile wind? And the architect said, no, but I like the ask. You've really piqued my curiosity. Now let's see. If I'm going to do this and you're paying me to do this, and by the way, I think the price of doing this was about 15% more than the ordinary houses built on average, right? They said, look, we need to put pylons. We need to put pylons in the ground, but not 10 feet, not 15 feet, not 20 feet, 40 feet. And we're going to put concrete in the walls. And we're going to put rebar in the walls. And we're going to see how this works. And then they put a camera on the outside under the eave of part of the house. And the physician was watching how this house was standing up in Tennessee, which is where he really lives. And he says the roof was rippling in the winds. I thought it was going to fly off any minute. Clearly, it did not. Again, they took on this task a year before the hurricane hit. They didn't know this hurricane was coming. They just knew that they liked this area and that hurricanes come here. So they wanted to build a house they thought might withstand the next hurricane. Clear enough, that's the job they did. It was successful. It was built to last. It was above minimum standards. So that's the kind of example of the work we like to do, above minimum standards for the benefit of our clients, because we're literally, in this together. And by the way, our compensation is tied to the performance of your account. So let's see, who's more interested in going up, you or me? And who's the least interested in it going down, you or me? I think we're pretty much tied at the hip. You want to go up, so do I, and you don't want it to go, and neither do I. So we want to limit the losses so that we can enjoy each other's company. So let's open up for Q&A. And Daniel, what do you want the audience to know?
If you'd like to ask a question, there's a Q&A box in your menu bar. You can ask a question through there, or you can send it through the chat, either one. I have a couple questions here for you, John.
Okay.
First one, how long do you think this is going to last?
Well, if you're talking about the coronavirus, I would say hopefully 2 months. I think we're about halfway there. So maybe another month or so. In terms of the market volatility, look, if people aren't working and we get to a situation where it's a replay of the Great Depression, which means, you don't have any interest in buying anything. By the way, one of the good news, not only in terms of the per capita ability to become a millionaire, right? The other thing that came out of one of the other things that came out of the Great Depression is people saved. We stopped doing that a long time ago. Maybe this kind of event will cause us to put our priorities back in order and recognize you must set aside some money every single paycheck. And if you don't do it, who's going to do it for you? And if you didn't do it, why are you on TV crying your eyes out? Because we're supposed to have pity for you. I'm sorry, you set yourself up. So let's set yourself up better to have a foundation. So as I say, I have $2-3 million behind door number one. And in 20, 30 years, 5 or 10 years, whatever it might be, that will provide that a reasonable withdrawal rate will provide me the kind of income I need, and maybe provide for a growing income because the returns are higher than the withdrawals, so that I can be here on this beautiful green earth and afford to live here and live like as though I was working for a living.
Excellent. Next question. What are your 2 suggestions for people already in retirement?
Well, let's tell you what. Let's do it both ways, Daniel. So we had a great appointment with a couple, and they brought in their granddaughter. This is one couple where I think we're at 4 generations, which I just love. And so we're all sitting at the conference room doing her numbers so she can see what she needs after she stops working for Northrop, where she just got her new job. And I said, look, I have to talk to you as though your grandparents aren't in the room. And then you could see the grandparents' ears perk up. I said, I know they can hear everything I'm saying, but look, when you see the markets, and I think this was not quite a year ago. So I said, at some point the market's going to decline. And what I want you to do is just keep adding to your account, because you want to think of it as like, shells on the seashore. You go get the shells when the tide goes out. So collect all the shares as though they were shells when the market is down or the tide is out. So that way, if the price ever comes back to a high water mark or where you began collecting these shares, you'll have more money. But don't get scared and don't stop adding to your account. You're going to need, in her case, I think it was $3 billion at 24, and that looks like a lot of money, and it is. So that's the first piece for people who have a lot of time. For people who are trying to live off of what they have, it's crucial. Let's do the math real quick. So let's suppose you're 70 and a half, January 2008. And at that time, you had to take out, what's the ratio, Daniel? It's changed.
It was at 70.5. It's 3.4%. It's now gone up to 72 as required minimum distributions, where we're at 3.6%.
Okay, so we'll make it easy. We'll just say you're taking out at 3%, but that's the IRS mandated in terms of required minimum distribution. So suppose you're 70 and a half in 2008, and you have to take out roughly 3%. We'll keep it at 3% to keep the math simple. That's only $30,000 from a $1 million account. account, right? That's not excessive. But then around March 8th, the market hurricane, if you will, from January 1, 2008 to March 8th, 2009, the hurricane took away 57%. That's minus $570,000 from $1 million plus your $30,000 withdrawal. 570 plus 30 is $600,000. That's to the minus. What was $1 million at the beginning of 2008 suddenly becomes $400,000. Oh, but wait, there's more. Remember, every year for the rest of your life from traditional retirement accounts, you must take increased withdrawals for the rest of your life. So that's my point. If you're taking out 3% and the market takes away 57%, you're only left with 400,000 from $1 million. That's not fun. And you have to take out a higher ratio the very next year. So we want to minimize the losses. And that's why we're saying many investors were not prepared for the last 2 months. They too look like it's shock and awe, which means you may not be prepared for the next 2 months, let alone the next 20 years. So we have an offer for you, and Daniel, you can speak to that, but we'd love to help you get prepared for whatever turns, the good, the bad, and the unforeseen.
So we're big on planning, and part of what we do for all their clients is we start with the financial plan, which is what what every advisor should do, and virtually none do. They typically just want to go to where we're going to put the money and what kind of return are we going to get. So we're strong on planning. We're offering specials on our financial plans we're doing it through up till tax time, so we'll still do it up until tax time. What is typically a $1,500 to $2,000 financial plan, we're offering for the cost of $500.
Beautiful. Any more questions? We did great. We promised to try to do this in 30 minutes, and we're there even with a couple of questions. So we're doing great.
One more question. Is it a good time to start investing perhaps with cash that we have on the sideline?
That's a good question. So, everybody gets a little shy when the market, but think of it this way. The two things, the elephant just kneeled. And, excuse me. Yeah, there may have been a 24% loss, but there's been a gain since right around the 25th of March. So I would say the best answer is, remember, you're going to need more money than you think for withdrawals to live on for, 30, 40 years. So maybe what you do is say, okay, we've got a substantial cash balance. How much of this do we want to ultimately invest? Let's say it was a year ago. You don't have to put it all in now, but you can put together a schedule which says that we're going to put in, say it's 500,000. I'm just making this up. So maybe you direct an investment of 50,000 twice a month for the next 5 months, and now we've got the $500,000 working, and that way we're kind of dollar cost averaging, and that way we could put the money to work. But again, make sure we make sure we know our losses, and then 2, have active management strategies to everything liquid, be it stocks, bonds, cash. Okay, all things liquid. And that's, I would say, the 1-2 punch that would help you weather this storm, no matter how ugly it might turn.
One more question before we let go, John. What indicators do you use from day to day?
From day to day? Well, I will tell you, maybe the 2 best things I can think of would be, if you're trying to get a sense of how the market's going to turn, then look at the pre-market the night before, the futures market. That sometimes gives you a sense of what might happen. The second thing to look at is oil. Stocks generally follow oil. And right now, I don't know if we're at the low, but it doesn't look very good for oil right now, which may indicate that these gains, for example, the last couple of days, might be indications of a dead cat bounce. I mean, back in October of 2008, Daniel and I, we follow this every day, and we saw, as I recall, a couple of days where the returns were over 10% in the day. Really? Now, that might give you, hey, here we go, we're off to the races. But remember, that was on the way from peak to trough, a 56, 57% loss from 1/1/08 through March 8th, 2009. So you certainly want to avoid all of that. But that would be what I would look at. Look at oil and look at the futures market. That'll give you a sense. But please, I mean, unless you're doing this professionally, I don't recommend you look at this every day. Okay, it'll drive you nuts. And please, let's put it in perspective. How would you feel if you paid? Because that's what you'd have to do if you own a house. How would you feel if you paid someone to come over and put tack the value of your house every day on your garage door? Great when it's going up, not so good when it's going down. Do you look at it every day? No, you don't. Okay, so don't get lost in the weeds here. Let's keep the big picture in mind and see what we can do to produce the results we want to achieve, whether it's retirement in 2 years or 20 years, or maintaining retirement, because we don't want those losses to be in our experience as we're taking withdrawals for life.
Excellent. Thank you, John. Appreciate that. Our contact information is on the screen. If you have any questions, please feel free to reach out to us at any time.
Thank you, everybody. We'll be back. This is a weekly thing. Wednesdays, our webinar at 3 o'clock, and the subjects will change, but the conversations will be rich.